To buy or not to buy? That is the question. Whether it is nobler in the mind to supine and not procure, or to acquire and suffer the slings and arrows of outrageous fortune in venturing into the marketplace. And that's how it feels every time that we buy a property. We rely on other brokers to bring us properties. We can't do this on our own, and the idea is that I often sit in meetings and a broker will say to me, but you know, of course, about this property and what's going on in the area, and you'll always see a very intelligent nod going on, but really I'm finding out about what's going on, and the information I get is invaluable. We do our due diligence when we acquire a property. We have a team that's led by Aaron and Mimi in our office who put together, we attack the property. We have an architect, an seismic engineer, mechanical engineer, our accountant. I'll schedule an appointment for one day and we'll comb through the property, and so that allows us to get to the bottom of it pretty quickly. Our investors' average size, although it started smaller, is $100,000 to $500,000 and up to $2 million or more if they're doing an exchange. The average return, this is where we get into that pre-recession, we're averaging 14%. At one point they dropped to 9%. This is to the investors in their pocket, cash on cash. They dropped to 9%, and they're now back to 11% on average. That's on about $100 million of invested funds. But our investors usually start at about a 7% return. It will go up over time, and if we can double, or if we can 1.5 or double their equity in a period of 6 to 10 years, that's about a 14% IRR, if that means anything to anybody in this room. And it can be better than that, and it can be worse too. And although standing here from the recession point of view, after supposedly 5 or 6 years later, I think we fared pretty well. We are in the business of raising money and investing in property, and sometimes we'll raise $20 million in a given year. So we're investing in property, and we're soliciting for funds in real estate. And although we see it more as just investing in real estate, this guy sitting here, Rob, who's about to speak, sees it more as a securities issue.
Traditional source, just normal banks, are now lending less. And so there are greater needs to supplement the capital. And so raising money from investors has become more important, and it's more and more people are sort of taking that route. Securities laws apply to offers and sales of securities. And as Stan mentioned, when you sell ownership interests in entities that invest in real estate, you're raising money from people that aren't in charge. That's probably a security that you're selling. So then there's a legal overlay which applies. So the securities laws were passed originally in the 30s because in the Great Depression there were all kinds of stock schemes. People lost huge amounts of money. And so the government felt like, okay, we need to get involved. We need to police this area. The best thing to do overall, just make sure that you're disclosing all the key information, and then make sure you fall within an exemption unless it's clearly a private offering.